Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast. It's Thursday, the 19th of March, and my name is Helen. Filling us in on the latest in financial markets today, I'll be speaking first of all to Roman Canziani, sharing his latest thoughts on oil and energy markets. I'm very happy that we have Norbert Rücker on the show today. And then finally, with an update on gold, I'll also be catching up with Carsten Menke. So that's all coming up in a few minutes, but over to you first of all, Roman, for the market news. Good morning.
Good morning, Helen.
So it's been a pretty turbulent 24 hours, largely influenced by escalating tensions in the Middle East, and volatility is back with a vengeance. So let's talk through it. How did European equity and bond markets react to the recent flare-up in geopolitical tensions?
Well, markets opened in the green yesterday as there were signs of de-escalation, but that hope proved fleeting. News of attacks on Iranian energy assets by Israel triggered a risk-off sentiment. European equities felt the pinch, turning deeply into the red. Specifically, the Stock 600 fell a bit more than 0.7%. We saw a bit of a mixed bag within sectors, with consumer staples taking the biggest hit, dropping 2.7%, while banks managed to buck the trend, actually rising 1.2%. Bond yields, particularly in Germany, also moved upwards as inflation fears weighed on the market. The yield on 2-year German notes increased 9 basis points to 2.48, reaching levels not seen since August.
Okay, all painting a clear picture of investor anxiety. Speaking of anxiety, let's turn to monetary policy. The whole situation seems to be complicating matters for central banks globally.
Precisely, the attack on Iranian energy assets has really thrown a wrench into the works. Traders are now fully pricing in 2 interest rate hikes from the European Central Bank this year, fueled by fears over that renewed inflation spike. The ECB meets today, but the expectation is for a hold, with all eyes on the forward guidance. Across the pond, we had some interesting and slightly concerning inflation data. The US producer price index rose significantly in February, so before the war was kicked off, climbing 0.7% month on month and 3.4% annually. This is the highest annual rate since February 2025, and this is certainly noted by the Federal Reserve.
So inflation remains a stubborn challenge. Jerome Powell didn't offer much reassurance either, if reports are to be believed.
No, he didn't. Following the Fed's decision to hold rates steady yesterday, Powell cautioned that surging oil prices can cause trouble for inflation expectations. He stressed that resuming rate cuts hinges on seeing tangible progress in bringing inflation down. But the Fed even revised its inflation forecast upward for 2026, projecting 2.7% instead of 2.4%. US markets reacted negatively to Powell's comments. The Dow Jones Industrial Average, the Nasdaq and the S&P 500 all closed sharply lower, down 1.6%, 1.5% and 1.4% respectively. The Dow shed about 770 points, with stocks like McDonald's and Visa among those experiencing significant declines.
Okay, and let's look at overnight action in Asia. What's the mood there?
Well, the negativity has carried over quite strongly. The overall Asia benchmark index is down almost 3% as investors reduced risk exposure. Japan's Nikkei 225 took a particularly heavy hit, tumbling almost 3.5% after the Bank of Japan's decision to leave rates unchanged, with traders also monitoring the yen closely, fearing it might breach 160 against the dollar. Futures on the Euro Stoxx 50 are down almost 2%, and US futures are also edging lower when I checked a few minutes ago. Crucially, Brent crude continues to climb, trading almost at $114 per barrel, fueled by these concerns about sustained disruption to energy supplies as Iran attacked an LNG facility in Qatar overnight, adding to the existing worries.
Well, that leads us neatly on to commodities. The energy sector has obviously been very much in the spotlight recently. I'll be speaking to Norbert in a moment to get his latest thoughts, but you told me that there have been strong inflows in the sector for quite some time already, right?
Absolutely. Well, investor flows into energy sector funds have accelerated dramatically at their fastest pace in over a decade over the past month. Global energy equity funds have already attracted around 2.1 billion US dollars alone this month. This is almost unprecedented. The combined market value of the top 25 oil companies has climbed roughly 20% this year, and the MSCI World Energy Index is up nearly 30%, significantly outpacing the broader market, of course. Obviously, investors are viewing energy as a geopolitical hedge, anticipating further price increases.
And looking ahead to today, you mentioned it already, we have key decisions coming from the ECB, the Bank of England and the Swiss National Bank. What should we be paying closest attention to, do you think?
Well, today is going to be pivotal. While all three central banks are widely expected to hold rates steady, the real story will be in their communication. Given the shifting landscape due to the Middle East conflict and persistent inflation, markets have drastically repriced expectations for future rate moves. For the ECB, the focus will be on whether they acknowledge the increasing probability of rate hikes later this year. Similarly, with the Bank of England, the market is now heavily leaning towards a potential hike by December this year, a stark contrast to previous expectations of cuts. Ultimately, investors will listen carefully for signals about how central banks intend to navigate this new era of increased uncertainty and evolving inflationary pressures. Their messaging will likely set the tone for the weeks and months ahead. That's it from me.
Very good. Thanks very much, Roman, for the markets wrap-up this morning.
Always a pleasure. Thank you very much, Helen.
And now on to energy markets and over to you, Norbert. Good morning. Welcome to the podcast.
Good morning, Helen.
Over the last 24 hours, we've had what seems to be an escalation of hostilities in the Middle East with attacks in the South Pars natural gas field. This also meant a move higher in energy prices. Roman just mentioned it. What's your take on the latest developments? Maybe you can also put this into context a bit.
Yeah, over the past hours, the conflict and the war in Iran really took up some steps on the escalation ladder. We had these attacks by US and Israeli on Iran's natural gas infrastructure. This serves purely domestic needs. And then the regime retaliated as warned, targeting some of the region's, the Gulf nations' key energy assets. While most of the missiles and drones were intercepted, there was some damage done in Qatar, and Qatar's Ras Al Afan natural gas hub, which is quite an important energy asset. This is really the export hub of natural gas to global markets, and Qatar itself is one of the top three producers. So if you look at the conflict overall, trade impasse around Hormuz is one thing, supply shutdowns, production shutdowns because of this impasse is another thing. But then you're really moving up the escalation ladder when you see production shutdowns and infrastructure damage. There's lots of uncertainties, but to which extent we really have now moved closer to a Baer scenario of a more lasting and intense energy shock should become only visible over the coming days.
European gas prices have also jumped massively. What should we make of this?
Well, it's actually interesting that the early reaction on the oil market was more pronounced than the one on the gas market, because the side that has been hit is really this key natural gas side. The escalation, as usual, really thickens the fog of war and brings a lot of new questions. And there specifically, what's the damage done? So far, we only know it's extensive damage, but this is a vast industrial site. And if you look at more closely, this has different kind of production units, different so-called trains where the gas is super chilled and exported. We don't know how much of this capacity affected. If it's one train, it's several trains. There's only few references to such kind of incidents, and we have to look back basically into the year 2019, where there was an attack on Saudi Qurar's oil site. There we had extensive damage, but operations resumed basically within weeks after repairs. So far, the gas market has shown quite some confidence that the temporary loss of Qatar supplies is digestible because exports are increasing elsewhere and because power generation is highly flexible and shifts to coal and renewables. But I think this confidence will be tested today and over the coming days.
All right. Overall then, in terms of energy markets, what are your latest views?
It's really the thickening of the fog of war and all these uncertainties, not only uncertainty about the damage done so far, but also the question this brings, because Qatar so far had better relations with Iran. So why did the attack happen in Qatar? Or also because the beneficiary of any prolonged outage will be the United States, because they are the ones increasing exports and benefiting if natural gas prices on global markets remain elevated. So the question is also, does this bring now a shift in the Gulf nations' roles, which so far have been primarily a defensive role that they took in this conflict? Or it also puts questions about basically Iran's remaining military strength, because they gave heavy warnings, but it was only one side where the attack in the end was successful. So overall, we're looking at a phase of increased stress level. We are looking at a phase of escalation concerns, of a thicker fog of war. This supports energy price for the time being, but if this really is a lasting escalation leading to a prolonged price spike, this remains open and to be seen. That said, the story which has been comforting, the story about a potential pickup of trade around Hormuz, because not of US safeguarding, but in fact because of Iranian safeguarding, that story has moved in the background, but we wouldn't be surprised if it comes back. So for the time being, we stick to our neutral views on oil and gas and still believe ultimately this is a temporary shock in energy prices that we are looking at. That's it.
Excellent. Thank you very much, Norbert. Great to have you on the show today.
Thanks for having me.
And now on to you, Carsten. Good morning, firstly. Welcome.
Good morning, Helen.
Now let's talk about precious metals. The market still seems to be very relaxed about the war.
Yes, indeed. So if we look across financial markets, I dare to say that gold and silver remain most relaxed, in fact. Prices continue to slide since the start of the week, slipping below $5,000 per ounce of gold and $80 per ounce of silver yesterday. While we have been highlighting that the geopolitics playbook typically does not provide lasting tailwinds to gold and silver prices, we are still somewhat surprised by this weak price performance.
How do you explain the weakness then?
Well, looking back, I think prices were on lofty levels when the war started, and one could argue that rising tensions in the Middle East were part of the appreciation since the start of the year. Any potential tailwind the war could bring for gold and silver due to its adverse economic impact from higher oil and gas prices, I think are currently offset by headwinds from the rebounding US dollar, rising US bond yields, and fears about less expansionary US monetary policy.
And I guess this is also the key takeaway from yesterday's Federal Reserve meeting.
Correct. The Fed did little to alleviate these fears as it left interest rates unchanged. Chairman Powell stressed the uncertainty the war brings to the economy and the upside risks for inflation from higher oil prices.
Sorry, I need to go back to the price weakness, though. Are the US dollar and US yields sufficient to explain it? The price moves look bigger than this, no?
Yeah, I know what you mean. So the precious metals are suffering from the rebound of the US dollar and the rise in US bond yields, particularly since their previous surge was very much built on the narrative of the dollar debasement trade. So those that had been betting on the precious metals to benefit from a debasement of the dollar were caught on the wrong side of this trade since the start of the war. Plus, safe haven seekers remain absent, which I think is very remarkable. We even struggle to see signs of bargain hunting at the moment, as physically backed products, which are a preferred gauge of safe haven demand, are recording continued outflows.
So what would need to change for gold and silver to shine again?
Well, I think this depends a lot on future developments in the Middle East and a worsening of the situation, including a more market risk off move in financial markets. This would likely be required for gold to shine. For silver, this would not necessarily be the case, as it does not possess the same safe haven characteristics as gold. And to a very large extent, silver is an industrial metal. So should the global economy slip into recession, silver is in fact set to suffer. So from that perspective, we reiterate a clear preference of gold over silver.
Wonderful. Thanks a lot, Carsten. Really interesting to speak to you again today.
Thank you. Bye-bye.
So that's it for today. Thank you again to Roman, Carsten and Norbert, and to you, our listeners, for tuning in. I hope you enjoyed the show. If you did, then make sure you subscribe if you haven't already. And please join us again tomorrow when I'll be back with more of my colleagues to talk about what is moving markets. Until then, though, have a great day, everyone, and bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.